In 2025, Washington faces an uncomfortable reality. After Donald Trump's failed bid to push India and China away from Russian oil, the White House has turned directly on Moscow with a fresh sanctions package. Yet the outcome is far different from what American strategists expected. Russia's economy, instead of collapsing, has adapted, and the ruble, once written off as doomed, has re-emerged as a surprising counterweight to the US dollar. When sanctions first hit in 2022, Western leaders believed they had cornered Moscow. State banks were cut off from SWIFT, reserves were frozen, and Western equipment, chips, and financing disappeared. A $60 per barrel oil price cap was imposed. Europe, once the largest buyer of Russian energy, abruptly cut ties. With revenues plunging, inflation soaring above 17%, and the ruble crashing past 120 to the dollar, many analysts predicted an unstoppable decline. But by 2025, the picture looks different. Moscow has redirected oil and gas flows eastward. China and India have stepped in as main buyers, with Beijing in particular providing lifeline trade and financing. A shadow fleet of more than 600 tankers now bypasses Western shippers and insurers. Transactions increasingly take place in yuan, rupees, and rubles. Oil is sold at steep discounts, $15 to $20 below Brent, but it still sells. As a result, Russia's economy, though slowed, has not broken. Inflation has fallen below 9%. The ruble has stabilized in the 80 to 90 per dollar range, and at times even outperformed the dollar. Instead of isolation, Moscow has built new networks of trade and finance. Washington, which once saw the ruble's collapse as proof of victory, now faces a currency more stable than expected and a Russia that has redrawn its economic map. This resilience has stunned many in the West. Every new sanctions package appears severe on paper, yet weaker in practice. In July 2025, Russian seaborne crude revenues fell 12% from the previous month, but pipeline exports rose, softening the blow. Revenues are down compared to pre-war levels, but the state still functions, adapts, and funds its war effort. The deeper problem for Washington is that sanctions are producing unintended consequences. Each time the U.S. freezes reserves or threatens secondary sanctions, it highlights how much control America wields over global finance. Instead of trust, this power now inspires fear. From Africa to the Middle East, leaders ask, if Washington can weaponize the dollar against Russia, what prevents it from doing the same to us? The reaction is reshaping trade. Russia and China now settle most energy deals in rubles and yuan. India has experimented with rupee settlements. Gulf states, once loyal to the petrodollar system, are openly considering yuan payments for oil to Asia. Every step chips away at the dollar's dominance. Ironically, Trump's own tariffs and sanctions accelerate the very process he warns against, de-dollarization. Perhaps the clearest signal came from India. When Washington hit New Delhi with tariffs of up to 50% on goods to punish its Russian oil purchases, India did not bend. Officials declared, "No one will dictate to us from whom we buy energy." For India, discounted Russian oil is not politics, but survival. Fuel for its factories, stability for its middle class, and security for millions moving into cities. Growth cannot be sacrificed for Washington's agenda. This firm stance reflects a wider shift. For decades, U.S. pressure forced governments to adjust. Today, from New Delhi to Beijing and beyond, more nations chart their own course. Even allies quietly hedge against American overreach. For Washington, this erosion of influence is dangerous. Sanctions remain its primary non-military tool, but they no longer guarantee compliance, which raises the key question: what can new sanctions on Russia actually achieve? Increasingly, the answer is little, unless Trump moves against China. Beijing is now Moscow's main economic pillar, buying energy and supplying goods once imported from the West. Without China, Russia would face far deeper crisis. With China, it survives. Yet this is where Trump's dilemma lies. Targeting China carries risks far beyond those with India. The U.S.-China trade war already burdens more than $300 billion in goods with record tariffs. American importers pay the price, and families feel it through inflation. If Trump were to add Russia-related sanctions on top, the disruption to supply chains could spark economic shock at home. For that reason, India can be punished with tariffs, but China remains untouchable, for now. The cost of this caution is obvious. As long as Beijing trades with Moscow, sanctions will never fully bite. Washington can keep tightening rules, but without China's cooperation, the regime is incomplete. This is why 2025 feels like a turning point. Russia has lost markets in Europe but gained Asia. India defies tariffs. China expands deals. The ruble, once dismissed, now symbolizes resilience. The dollar, though still dominant, no longer feels unshakable. Each new sanction makes rivals more determined to build alternatives. The real struggle is no longer just about Russian oil or banking restrictions. It is about who sets the rules of global trade. For decades, the United States did. But today, cracks are visible. Washington can punish, but it cannot compel. Its rivals adapt, resist, and sometimes thrive. The balance of power is shifting faster than America can respond. And that leaves the uncomfortable truth. In this sanctions war, the advantage may not belong to the U.S. anymore. The more Washington presses, the more the world questions its dominance. The harder it leans on the dollar, the faster nations create systems to escape it. Once those systems reach scale, returning to a dollar-centered order will be almost impossible. The final question is not whether Russia survives, it already has, but whether the United States still controls the architecture of global commerce. That answer will define not just the future of sanctions, but the future of American power itself.